Three most widely used financial statements are balance sheet, income statement, and statement of cash flow. And in this video, I'm going to introduce you the basics of balance sheet. And keep in mind, I'm not going to cover how balance sheet is created because it is covered in introductory accounting class. Since this is an introductory finance class, I want to focus on how the information given in the balance sheet is used rather than how to create balance sheet. So I want to start with a very basic question, that is, what is balance sheet? As you all know from your introductory account class, balance sheets provide users the information regarding a company's assets, liabilities, and equity at a specific point in time. All right. The basic format of the balance sheet look like this, right? So you have assets on the left hand side of your balance sheet, and on the right hand side you have liabilities and stockholders equity, or simply equity. So the asset basically means what the company owns today to generate future economic benefit for the company, right? And liability, this guy here, is how much the company owes today, and it usually represents company's obligation to its creditors. And equity, this portion, is what the company worth today, and it represents how much is left to the owners of the company after deducting all liabilities from company's assets. Let's look at major component of balance sheet. So I want to start with this current assets, right? These current assets, and also called working assets, and this represents those assets that are expected to be converted into cash within 1 year. And they include cash and cash equivalent, account receivables, inventories, prepaid expenses, and other current assets. And see how these current assets are listed in the order of liquidity. Most liquid, like cash and cash equivalent, is on the top, and then account receivable and inventories, and so on and so forth. If you don't know the meaning of each of this account, I encourage you to learn it using any source that you are familiar with. So the next important component of balance sheet is the long-term assets, and those are less liquid assets and not expected to be converted into cash within 1 year, and that includes fixed assets such as net property, plant, and equipment, and other long-term assets such as intangible assets, goodwill, patent, and trademark. So that makes the current assets and long-term assets makes the total assets for that company, which represents all the assets the company owns that can be used to generate future economic benefit for that company, right? So the next important component of the balance sheet is current liabilities, and it represents all the obligations that are likely to be paid within 1 year. And major components of current liabilities are accounts payable, current portion of the date, accrued expenses, and other current liabilities. And another important component of balance sheet is long-term liabilities, and it basically refers to long-term debt in leases and other long-term liabilities. And non-current liabilities are one of the sources of long-term financing and are not expected to convert it into cash within 1 year. And the next and the most important part of the balance sheet is stockholders' equity. It represents company's value to its owner, right? And it is the sum of the various components such as preferred stock, common stock, treasury shares, and retained earning. So these are the liabilities, and if you add the current liabilities, long-term liabilities, and stockholders equity, that gives us the liability and stockholder equity. And if you know from your basic accounting class, the total assets should always be equal to the total liabilities and stockholder equity. That means what the company owns must be equal to what it owes and what is left to the owners of that company. One important concept that I would like to emphasize here is working capital. And this is very important concept going forward in the future, especially when we want to find the value of a company. And slightly two basic concepts I want to emphasize here. One is net working capital and net operating working capital. And this net working capital is usually computed as current assets minus current liabilities, and it is the amount of money the company has to work with in the short term. So higher that number means more current assets than liabilities. And another important concept is net operating working capital, which is computed as account receivable plus inventories plus prepaid expenses, right, minus the sum of accounts payable, accrued expenses, and income tax payable. And remember here, when you compute net operating working capital, it does not include cash and marketable securities in calculation of the current assets, and it does not include short-term debt and current portion of the long-term debt in computing current liabilities. And this net operating working capital concept is very important when we want to compute the value of the company. You can obtain the balance sheet from different sources such as company's website or annual report, free sources such as Yahoo Finance, or private data vendors such as Mergent Online. And I am going to get balance sheet from Mergent Online because Mergent Online has a lot more information than balance sheet, and we are going to use this in the future. So let's get to our Humboldt State University library, and I'm here. So click on this search, locate like article and databases, and if you click on article databases, you can click on the business, and then after you see all the databases that we have and click on Mergent Online, it will take you to the Mergent Online homepage, and now you can search any company that you are interested. And I am going to just look for Tesla, T-S-L-A, right? Tesla. And now it's just the name. Click on there. And now you have here all information regarding Tesla, and you can click each of these links and read as much as you can, but I want to focus on company financial, so let me click here. And now see here there are different options to choose from: as reported, preliminary, standardized, restated, ratio analysis. And now what I want to do is I want to click on as reported, and now you have the option to choose the frequency, annual versus quarter, and there are different statement that you can choose from, and I'm choosing here balance sheet, and I have 5 years versus 7 years, 10 years, whatever time period you are interested. You can choose and click on That I'm choosing here 7 year, and if you make that selection and click refresh, and now you have your all data available to you. And good thing in Mergent is the data is stored in Excel file. You can click here and save on the desktop or wherever you want to save. So that is as reported, and I will be also using standardized balance sheet. So click on the standardized balance sheet, and again same selection, right? Annual balance sheet, 7 years of data. And good thing about the standardize is Mergent works hard to standardize this balance sheet so that the comparison across companies becomes easier. And here you have all these items, and there's a what sign next to this item, and if you don't know any of these items, you can take your mouse to next to it and you can read what that item means. And I encourage you to read each and every item and get familiar with. And again, on the top you have again the data in Excel file. You can download it, and once you have as reported and standardized balances downloaded, combine them into your Excel file. And to save our time, I have already done, and I want to work off of that. Here is the Excel file that combines my as reported balance sheet and standardized balance sheet here. And what I want to do is I want to make some adjustment before I start using this information. And some of the adjustment means basically what I have done is I have replaced all these total subtotals with the formula, and more importantly, two lines I have added. See this red color here, total non-current assets and total non-current liability. Please make that adjustment to your company as well, looking this as an example since I'm going to upload this file in the course website. And now more importantly, what we want to understand is how can we use the information provided in the balance sheet. And as you know that the information provided in balance sheet is useful for investors, to managers, to a lot of people who are interested, right? So what are the tools available to us in order to use the information provided in the balance sheet? And there are basically three tools that I have been focusing, right? So the tools here, one is the common size balance sheet. What do you do there? You express all item as a percent of total assets. And we have ratios. We can calculate different kind of ratios and then see where the company stands. And we can also use chart and graphs. So these are the three basic tools you can use in order to utilize information given in the balance sheet. When you analyze company using these tools, usually we do two kind of analysis. One is the cross-sectional, and another one is a trend analysis. So in cross-sectional analysis, what do you do is you compute all the ratios that you are interested, and I would say this is ratio 1, ratio 2, ratio 3, and so on and so forth, and you compute this ratio for your company, right? Your company. And you also compute this ratio for industry, that company is industry average, and also for the market. So you compute the same ratios for your company, your industry, and for the market, and you compare how your company is doing against the industry average as well as the market. And some ratios are considered to be better if they are big, and some are better if they are small. So it depends what kind of ratios you are computing. And another way you always analyze companies are this trend analysis. What do you do here is usually you look at what is happening over time. So you have here time. It could be year 1, 2, 3, 4, 5, and then your measures that you are looking at, right? And here measure, and you see whether that is increasing or whether it is declining or it is staying same. So you look at the trend and decide whether the company is doing. Yes, in this example I have created here common size annual balance sheet. in this common size balance sheet, what I have done is I have divided each item by the total assets of that year and express that all item as a percent of total assets. And I have also computed median and the mean, and that's good to look at what is happening over periods and compare that mean or the median against the industry average or the market. And once you compute these common size items, you can look at what is happening over period. For example, I want to see what is happening to current assets and current liabilities as a percent of total assets over the 5 year. So what I can do is press Control and choose the year from 1 to 5, right? And then after, press the item that you are interested. So I want to look at the current assets, right? Current assets as a percent of total assets, and I want to see current liabilities as a percent of total assets and see what is happening. So I make that selection, and once you make that selection, go to Insert and then 2D graph. You can plot this 2D graph, and this is how it looks like. So here the two lines that represent total current assets and total current liabilities, and by looking at this figure you can see what is happening over period. And that's a trend analysis, and you can do this kind of trend analysis for all sorts of item that you are interested in. Another important tools is the ratio analysis. So there are different kind of ratios, right? And most commonly used ratios are these directly from balance sheet. The liquidity measures, current ratio, quick ratio, long-term solvency measures, book debt to equity, debt to capital ratio, and so on and so forth. And if you want to know more about these, you can definitely learn that. This video is getting long, so what I want to do is I want to show you here, like you can compute this current ratio as the cash plus marketable securities plus receivables over current liabilities. That's a quick ratio, right? Similarly, you can compute the current ratio, and you can also compute this debt to enterprise value ratio, like net debt over net debt plus market value of equity. Once you compute this ratio, you can see how it is changing over period. For example, I want to see these total debt to equity over 5 years, so I can select that date and press Control, and I can select this total debt to equity for the next 5 years, and then insert here again 2D graph, and that tells me, or that gives me a visual picture of what is happening total debt to equity over 5 years. This is just an example, and you can do similar analysis for other ratios. Since I'm going to upload this in the course website, please make sure that how I have computed each ratios and calculate similar ratios for your company. Thank